So how much down payment do you really need for an owner finance property? Do you own the property from the get-go, or is it a contract for deed? And how do you identify owner finance scams, and so you can make sure you prevent yourself from falling victim to one of these scams that are out there? I'm Joe Chavarria, and this is another exciting episode of Cup of Joe. So today, what I want to talk about 7 things that you need to know before you go and do an owner finance home. 7 things you need to know about owner finance properties. And before I dive in, I want to remind everybody to like, share, and subscribe to this content. And also, if you're currently in the market, I'm really curious. I'm really wanting to know how this is resonating with my audience. If you're currently in the market, you're looking at Craigslist for sale by owner listings, whether it be newspaper or online, or you got a realtor looking for sale by owner properties, or even if you are on Facebook Marketplace and you're looking for sale by owner deals and you're looking at deals that have owner financing. If that is you, comment yes below. If it's not you, comment no below, because I just want to know again what my audience is where you're at with everything, and just to know if my content is resonating well with my audience, so I can continue delivering and tailoring my content to fit my audience. And so again, so let's kind of dive in here. So topic number 1, the first thing you want to know is regarding the down payment. So let me kind of preface by saying on the down payment that there are a lot of options outside of owner financing or seller financing. So if you think that's the only way for you, let me just kind of start off by talking about a couple of other options for you that you may or may not be aware of, and then you can kind of decide, if that still is the owner financing, is that still the best route for you. So you have your VA loans, which are for veterans, people that have served in the military. The VA will give you what's called your VA benefits, and you can apply those VA benefits to a mortgage loan scenario, and you can get what's called a VA mortgage loan. So your VA loans are 0% down, so it's 100% financing. So that's one way you can get into a property with next to nothing down. You have your FHA loans, which many of them, if you qualify, you can get a grant or some kind of down payment assistance program, and that can cover your full down payment, or you may come to the table with 0.5% down, so like half a percentage for a down payment. So it can be maybe $500 up to $2,000 depending on the size of the property you're looking at. So next to nothing down with FHA, with the down payment assistance option applied towards it. Then you have your standard FHA loans, typically about 3.5% to 5% down. And then you have your conventional mortgages, which conventional mortgages can be anywhere between 5% up to 20% down, just depending on how what kind of loan you're looking at, if short-term loan versus a 30-year fix. If you want a lower rate, lower payment, things like that, you can come to the table with a little bit more down. But I'm seeing pretty much standard, pretty much minimum with mortgage lenders right around 5% for your conventional mortgage. Then you have owner financing. Then you have seller financing, owner financing, pretty much the same thing. Owner financing is basically if you're the owner financing the property, you're owner financing the property. If you're on the buyer side, you're looking to buy it, then you're looking at it from seller financing. The seller's providing financing to you. So that's kind of how you distinguish the two, but actually they're pretty much the same thing. So in an owner finance deal, you're typically the standard down payment that I'm seeing with owner finance properties, legitimate owner finance properties, is 10% on the low end, 30% on the high end, 20% pretty much average, right around there. And so what that equates to, say that you're looking at a property that is listed for $200,000, right? And so your 20% down payment would be $40,000. That's going to be what you'll need to come to the table as far as down payment if you're looking at a 20% owner finance deal. So about $40,000 on a $200,000 property. Obviously, the higher property, the more down payment you need to put into, or even on the same 200,000, 30% down, maybe obviously more than $40,000. So that's just kind of standard with owner finance deals, right around 20%. So it's a lot of money, right? And so you can also find yourself in a bidding war. So what I mean by that is that there's not a lot of owner finance properties that are in good condition, move-in ready, close to new, that are out there. And when they are out there, they're very competitive because there's a lot of people that have cash, that have the money, and are looking at these similar scenarios. And the reason why is because of credit, because you don't have to have great credit. You don't really have to have any credit in many cases. Sometimes you don't even have a social. And that's kind of where a lot of the owner finance scams come into place. Is some investors or owners kind of taking advantage of immigrants or people that are new, don't have a social, don't know better, but they have cash. They came into this country, started a business, construction company, landscaping company, whatever, and they got some cash. They've been saving some money, and then all of a sudden they they can't buy a house because they don't have a social, don't have credit, and so they sometimes can fall victim to these owner finance scams, which is where the owner would take the cash, or the investor would take the cash, and I should say investor with air quotes, take the cash, and then they're gone, right? They say, hey, give me $5,000, I'll secure the property, and then they're gone, right? So, and I'm going to lead into some other things here and to avoid that. But that's why the down payment in the first place is so high, because you don't have to have bank financing, you don't have to have credit, good credit even to qualify for some financing to buy the house. So that's why owner financing can be very attractive to some people, because it allows that individual to not have to go through the bank to get the financing. They're working outside of the banks, working directly with the owner or the investor in that scenario. But the down payment can be quite a bit in an owner finance transaction. All right, that's number one. Number two, the interest rate. Let's talk about the interest rate for a little bit. The second thing you need to know is what kind of interest rate you can expect to pay on an owner finance property. And so typically with mortgages, with your standard mortgage, VA, FHA, conventional, you're going to be anywhere between 3% in a good market, a buyer's market even, or up to about maybe 6%, right? Typically mortgage interest rates kind of are right in that zone, 3% to 5%, depending on where the credit's at, depending on the market, depending on what kind of buyer's market, seller's market, and also kind of depending on how much down payment you put in as well. So anywhere between 3 and 6%. And so with an owner finance deal, typically the interest rate is going to be anywhere between like 6% on the low end, up to 10, sometimes 11% interest on an owner finance deal. So you're paying a lot more in interest, a lot more per month. And it's the way that the owner or the investor makes their money is they're going to make their money on the down payment. They're going to make their money in the interest rate. So, it's kind of like, hey, this is how we make our money on this deal, because we're not selling the property outright. We're going to provide some financing. So we got to make the money on the financing. Right, so they'll have a higher interest rate compared to your bank rate, and so that's one thing to consider on that. Also, let's talk about the underlying lien. Okay, so underlying liens could be existing mortgages that are on the property, or even tax liens or judgments, anything that's filed against the property that's on there. And so you want to make sure that you understand what underlying liens are even on the property. Okay, so, and this is number 3, right? Number 3 is underlying liens. You need to understand where if there are any underlying liens on the property. You can obviously ask the owner, ask the investor, and they may be truthful and tell you if there's any existing mortgages that are on it and or any kind of liens that are on it. And why you need to know that is because let's say that there is a tax lien on the property that you're not aware of, and the owner or the investor has been paying that tax lien maybe on a monthly basis or has a promise to pay. But let's say that you get the property, they're like, okay, I'm not even going to mention the tax lien. I don't even care about it because I got my money. I'm moving on. Then the government, whether it be state or federal, can basically issue they could attempt to accelerate the loan or accelerate their money, call their money due, and if they don't get the lien paid up, then they can foreclose on the property because they have right to the property. Due to non-payment, they can foreclose, and all of a sudden the property's gone. You didn't even know about it. You didn't know why it's even gone. And maybe not so much on like tax lien scenarios. This is definitely more so when it comes to like existing mortgages. Let's say that the owner or the investor has an existing mortgage on the property, and if that existing mortgage doesn't get paid, then that mortgage company, since they have a first position on that property, then they have the right to foreclose due to non-payment. And again, you may not be aware of that. So you want to get with a good title company or do a title search and find out what kind of liens are on the property, if there are already existing mortgages on the property. It's good for you to know that before you go into that situation there. The fourth thing I want to talk about is balloon payments. So this is something that's not really discussed on the front end, or even if it is discussed on the front end, most people don't remember or don't really understand what a balloon payment is. So when it comes to seller financing or owner financing, the owner or the landlord may provide a 30-year loan or a loan amortized over 30 years, but it has like a 3 to 5 year balloon payment. And what that means is in 3 or 5 years, whatever time frame that they set for the balloon payment, the owner or the investor, they have the right to call that loan due, or call the entire loan due at the balloon period mature date. So let's say it's like a 3-year balloon, 30-year loan, 3-year balloon. So at year number 3, the owner can say, okay, great. So we need you to go ahead and pay us off in full, or you need to get a loan. Otherwise, the loan is no matter what, is going to be accelerated. So let's just say let's take a $200,000 property, for example. You put 40 grand down, so your balance is like 160. You've been paying monthly payments, interest, principal, everything for about 3 years now. And let's say your balance is about, let's just say 145. And so year 3 hits, and then the owner can say, okay, great. Now we need the 145 in full. Either you come up with the cash, or you refinance, you get your own loan to pay off my 145. If you can't pay the 145, then I'm going to foreclose on the property, get my property back. That's a balloon payment. So you need to find out, are there any balloon payments in this transaction? Is it a 3-year balloon, 5-year balloon, no balloon? If there's no balloon, that's great. If there is a balloon, you need to find out when that balloon date is. And you need to have some backup plans in place to be ready for that balloon payment dates. Because if you're not, let's say your reason why you're looking at owner financing is due to poor credit scores, then you need to start working on your credit right away. So that way you can get your own financing at year 1 or month 6 or year 2, however time it takes you, and you can get your own loan lined up. Let's say that's not really credit, but let's say you had a foreclosure a year ago and you need to wait about 2 to 3 years since that foreclosure date in order to get a mortgage. Okay, well, you need to know that to see if that balloon time frame is going to be enough time for that foreclosure date to pass with your previous mortgage, so you can go and get your own mortgage. So you want to be prepared for all of that, understand if there is a balloon payment or not, so you're not caught off guard and all of a sudden the owner or the investor is saying, okay, time to pay us off, or we're going to foreclose on the property. So that's basically the balloon payment. So that's number 4. Number 5 is deed or the title. Okay, do you own the property from the very beginning? Meaning you get the deed, right? The home is in your name. You give the down payment. You go to the title company, you do all the closing, all that stuff, and do you get the deed, right? Or is your name registered on the deed? You are now the rightful owner. That deed is then filed with the county, and you are the rightful owner of that property, right? Or is it a contract for deed, meaning that after a certain period of time, or until the entire loan has been paid off, the owner finance loan has been paid off, maybe then you get the deed. So you want to get some specifics as to when do you get the title? When do you get the ownership, the official deed of the property? Is it in the very beginning, which most owner finance deals there are in the very beginning, or is it going to be towards the very end, maybe the latter part of the loan, or the end of the loan once everything's been paid off? Then you get the deed. I'm not a fan of towards the very end. I do believe that if there's somebody providing financing, you put the down payment, you're doing the monthly, all that stuff, you should be getting the deed. You should be the rightful owner from the get-go, because even though you're not going through a bank, it's a very similar concept. It's just, the owners provide the financing as opposed to the bank. And those kinds of scenarios, the new owner of the property does get contract as well. So 2 more things I want to talk about. Number 1, wraparound mortgage, and then number 2, getting professional help. But before I do that, I want to just again remind everybody, like, share, and subscribe. Drop a comment below if you're in the position of becoming a homeowner and you're looking at owner financing scenarios, and you are in that process. I'd love to know how you guys are doing with that. So, okay, so 2 more. And so number 6 is the wraparound mortgage. So a wraparound mortgage is where the owner has an existing mortgage already on the property, and then they are going to wrap their mortgage around, around, because it's called wraparound, a new loan they're making with you, which is the seller owner financing part of it all. And basically that's called a wraparound mortgage. Okay, so there's an existing mortgage, and so what that means is the monthly payment, the new loan that you're going to be paying, there's going to be enough principal, interest, taxes, insurance, all of that to cover the underlying mortgage, to cover that PTI payment, principal, interest, taxes, insurance, right? And of course, there's going to be room there for the new interest rate so that the owner still makes a monthly profit. So let's say that you're looking at an owner finance deal. The owner has a Chase mortgage on there, and the Chase mortgage is 3%. And then you're looking at it from an owner finance perspective. The owner may be giving you 7%. So that 4% difference is going to be the profit that the owner is going to make on that deal. What's really cool about wraparound mortgages, well, first and foremost, you need to know that there is one or not, because you got to make sure that it does get paid. But with wraparound mortgages, you can get a servicing company involved with this, which I would recommend that you do. And the servicing company will collect payment from you. They'll disperse that payment to the bank, to the owner's profit, right? And then they'll basically take a portion for their fee, and they report their payments to their credit report. So let's say that with the wraparound mortgage, that your payment on the deal is going to be $1,700 a month. Okay. So you pay your $1,700 to the servicing company. Maybe 25 to 30 of that would go towards the servicing fee for the servicing company. The majority of that's going to go to principal, interest, taxes, insurance to the underlying mortgage, and then there's going to be probably $200 in there for the profit on the interest that would go towards the owner. They'll cut the check to the owner. They'll pay the bank. They'll pay the existing mortgage, and then they'll take their fee. I like, if you're really doing an owner finance deal and there's an existing mortgage on their property, I highly recommend getting a servicing company in this type of scenario, because you get the credit reporting. So if credit is weak, right, it's poor, and you need to kind of build some credit, then they can get your mortgage payments to report to your credit report. They handle all the accounting aspect of it. So when it comes time to doing taxes, they have a record for your interest rate that you've paid, so you can write that off. And just kind of like all the other accounting aspects of it all is taken care of by that servicing company, and you don't have to send the money like directly to the owner or to the investor, and hope that they make the payment to the mortgage company, because what if they don't? Then that could be a big problem. So this is kind of like your protection to ensure that it does get handled appropriately. So last but not least, the seventh thing that I wanted to talk to you about regarding owner finance properties is you got to get some professional help. Do not do this alone. Do not just deal directly with someone on Craigslist or on Facebook, or Facebook marketplaces, or just on the for sale by owner websites. You need to have professional representation. You can get a realtor. Many people don't want to get a realtor because they think that, the realtor is not really going to help them because they don't really know this transaction. Or some people believe that, or some realtors don't do these kind of deals because they don't think they're going to get paid, so they don't want to get involved. There are a handful of real estate agents that are out there that do owner finance transactions, that they know how to negotiate for their fee to get paid by the owner, by the seller in that deal. And they're familiarized with this process, and they can do all the heavy lifting for you. So definitely get with the realtor. Granted, you're not going to be able to find a lot of realtors in this because, again, this is a special type of transaction. But there are realtors out there that do these deals. Post something on Facebook if you have to, looking for a realtor that knows owner finance transactions. I'm sure you'll find somebody, right? Get an attorney, right? If you don't get a realtor, then you need to get yourself a real estate agent, a real estate attorney, right? Someone who can review the contracts, someone who can do all the paperwork to ensure it's done compliantly, review the contracts, right? Just to make sure you're getting a fair share of the deal, you know what you're getting into. So maybe a real estate attorney can help you, or even a title company. Right? A title company, so that way you can do the title search, you can get title insurance if you need to, so you can ensure that you have a good title that's not clouded, there's no owners that are still lingering on the title, there's no liens filed against the property, no underlying mortgages that are on there. So if you want to get a good clean title, then you want to get with a good title company and get that taken care of for you in advance. And some other professional help you may need is an inspector, an appraiser, just to make sure that you know the repairs that may be needed on the property, how much the house is really worth. That's information that you need to do. So I know what a lot of you are thinking. Sometimes if you're in this situation and you just need to move quickly, you need something right, you've been waiting, you've been patient, now you want to own your own house. I'm telling you, do your due diligence, take your time, do your research. Do not just rush into this. get yourself an agent, get yourself an attorney if you need to, get yourself a title company, review this video many times, ask the key questions. Are there underlying liens, underlying mortgages? Do you get the deed or do you not? What's the interest rate? Is there a balloon payment? How much down? You need to know this information before you make a final decision. And after all that, if everything still makes sense, at least now you did all the research and you're not going to be caught off guard and not have anything subject to surprise. So that's my thing for today. That's 7 things you need to know about owner finance properties. Again, I want to remind everybody to like, share, and subscribe to my content. And just curious, again, if you're in the market, you're looking at owner finance deals, and the reason why you're looking at owner finance properties is because of your credit, right? The reason why you're not going to the bank is only because of credit. Then I suggest that you fill out the form below. There's going to be a link in the description, and allow one of my team members to do a complimentary credit review for you. That way we can educate you on what you can do on your own credit. That's complimentary to you. If you want to hire us, of course, we have our fee. We'll go over all that with you. And we'll basically, if you want us to do all the legwork for you to repair your credit, remove negative items, coach you on building credit, we're happy to do that as well. But at the very least, get some clarity, get a free complimentary, credit consultation going, so you kind of get an understanding of where you stand, what you need to do, so you can kind of make some good decisions as it relates to any balloon payments, any kind of special financing. Again, if that's the only thing that's holding you back from getting bank financing is your credit, give us a call. Fill out the link, fill out the form in the link there. Let us give you some clarity on that. Our program's not a long program. It's actually probably about, between 2 months on the fast end, up to about 6 months on the slow one, I guess you want to call it like that. But within 2 to 6 months, we can do a lot of wonders for your credit and help you get pre-approved for bank loans. So you don't even have to mess with all of this when it comes to owner finance properties. So again, guys, I'm Joe Chavarria. Thanks for tuning in on another episode of Cup of Joe. I'll see you on the next one. Take care.